pleasure to introduce to you AJ Tikla, the Vice President and Product Strategist at BlackRock, and Dr. Philip Gistakis, from an Oxford Financial Mathematics graduate and currently the Chief Investment Officer in Wealth Management at Hypo Vereinsbank. They will share their opinions on how technology disrupts the world and about why it's important for the investment in the stock market. I'll share the screen. Just 1 second. Here we go.
Great. So I hope everyone can hear me. Is that okay? Great. So my name is Philip Gistakis. I'm Chief Investment Officer, Wealth Management Private Banking at HVB. And what we do is we offer multi-asset investment solutions for clients in form of discretionary portfolio management, DPM, that's also known as segregated account. And within that service, we offer clients access to liquid asset classes such as bonds and stocks. And during the Corona crisis, actually, we managed our portfolios with less drawdowns than the overall market. And why was that the case? Among the reasons there is that we had a pretty large exposure to sectors that were doing pretty well, and that included technology and healthcare. Those were very resilient, while more cyclical sectors like automobiles, airlines, oil and gas, we didn't do. And why have we done that? Because we aimed for a less cyclical risk profile in our portfolios. What are the lessons learned out of that? The lessons learned out of that is that an active management involving the perspective of the cyclicality of your sectors and so on is a very important feature. And we want to also share now and as I said, is that investments in technology was an important building block. And this is what we wanted to discuss right now. And in order to shed some more light on the issue of investing in tech companies in financial markets, we teamed up with colleagues from BlackRock, and we invited AJ Ziegler from BlackRock, with whom we discuss his participation in a very successful global technology team, which is based in San Francisco. And he is also participating to BlackRock's World Technology Fund and the Next Generation Technology Fund, which have each generated over 60% of return year to date, and which is more than double the return of the technology sector as a whole. Considering that about global stocks are up 4% this year, these are truly extraordinary returns. And the team has outperformed over 85% of technology managers, not just this year, but over the past 1, 3, and 5 year periods, which show great consistency in outperformance. Now, let me briefly introduce AJ, whom you see there. AJ is a CFA, Vice President at BlackRock, and he's based in London. He's a product strategist within the Active Equities Group at BlackRock, representing global sector and thematic equity strategy. In his capacity, he primarily supports the investment team in global basis, both retail and institutional clients, and he's responsible for providing the link between investment team and all client groups, as well as providing insights on the active equity product platform. Now, AJ, we heard in the introduction that sector allocation and sector rotation, which is changing the allocation to different sectors over the cycle, matters in investment process. And we also heard that technology was a very successful sector. But the question is, can technology actually be considered a sector, or is it a homogeneous sector, or is it more than that?
Yeah, it's a great question. And first off, thank you for having me, and thanks to everyone dialed in. You know, this is truly a exciting time to be talking about the technology sector. You know, just this year, as you mentioned, Philip, you know, global equity markets are up 4%, the tech sector's up 30%, and our funds have been up, you know, nearly 60%. It's been an incredible year. And Before I touch on the homogeneous sector and how we think about it, just to take a step back and think why technology, and we show on the next slide, you know, this is a sector that, structurally is defined by innovation and disruption. It's defined by disruption and innovation. It's also defined by broader global growth trends and also a societal resilience on technology. And I see some of the questions coming in about, cyclicality and resilience. Tech has been an area of resilience this year and been very impressive. And the reason I think it's so important to look at technology, 15 years ago, this is a sector that would have been just 6% of an equity portfolio. Now it's nearing 20%. It's much greater in terms of an allocation, really closer to 24%. So with that background of why technology, to touch on the question, directly, is this more or less a homogeneous sector? Well, I would look at the next slide. This is a sector defined by change and disruption. Every decade or so, there's a massive shift in which companies are really the leaders of the tech space. And when you look at these companies, and for those of you dialed in on the phone, we show the change in leadership of the top 20 tech companies per decade has nearly 60, 70% turnover every year. So you really need to be active in the space. It's a fast moving sector because the types of companies that are going to be leaders tomorrow aren't likely to be the leaders of today.
So how often actually do you then look out of the bubble, the traditional sector bubble in technology?
Yeah, I think really all the time. And I see a question coming in about Shopify in the 2020. I think it depends on when we took a snapshot of this, but Shopify is a great example of one that's really emerged into the current leaders of tech. And to take that question about how do we look outside the traditional tech sector? And on that Shopify, that's a perfect example. Shopify is a company that some may say wouldn't be categorized as a tech company. They may call it a consumer discretionary company. So how do we include that in our universe? If you look at the next slide, you really redefine the definition of what is technology, what is the global technology universe. When you look at index providers like GICS or MSCI, it's difficult to keep up with the fast changing pace of technology disruption. And Philip, just to give an example, you see this internet bucket on this page. By a lot of classification definitions, these companies are sometimes outside of the tech sector. So companies like Amazon, Netflix, Facebook, a lot of those names that are in the top 20, if you invest in just the technology index, you actually wouldn't have exposure to those companies. So we redefine the universe. We use the phrase, tech beyond tech. Technology is disrupting multiple different sectors and industries. So we want to set a very wide landscape for what we consider technology.
So you look at a very wide range. In the introduction, we heard that you have a considerable outperformance of the tech sector as a whole. How do you manage to do that? How do you outperform the benchmark? What is your basically the way how you perform in order to create that outperformance? What are your ideas behind that?
Sure. As you mentioned in the beginning, we have a team based in San Francisco, really dedicated to the technology sector. And I think, to summarize, I think three ways that we aim to beat the benchmark. And first off, by what we mean by beat the benchmark, we want to beat the technology index, an index of stocks that's market cap weighted to technology companies. Step one, you got to look beyond the traditional technology definition. Use this universe that we have shown on the slide. Look beyond the traditional technology universe, because tech disruption isn't constrained to just one area of the market. Maybe 10, 15 years ago, tech disruption would be Dell and HP competing over desktop computers. But now you're seeing tech disrupt areas of financials, of communications, and much beyond. So setting a broad universe. Step two, be looking beyond the FANGs. FANGs is Facebook, Alphabet, Amazon, Google, Netflix, the big tech companies, the mega caps. These are the companies you hear a lot in the media and are huge conglomerate type companies. But if you want to beat the benchmark, you're going to have to look beyond just those big tech companies. And that's something that we do quite often. And then step three is really look at some of the sub-themes driving technology. It's not just cloud computing. It's not just artificial intelligence. It's multiple different themes that are really reshaping the world we live in today. And we want to capture multiple sub-themes within that. So those, I would say, the three, looking tech, beyond just the mega caps, and really looking at some of the fast-growing themes in the technology universe.
Oh, that's interesting. So it's basically not only a sector, what you said, but within the sector, you look at themes. What? Tell us more about that. What are the themes that you're actually looking at in your investment process?
That's exactly right. We use the term sector a lot. A lot of times I almost try to change that to, technology universe, because it's just more than the sector. And we identify, the team spends a lot of time identifying these themes that are going to reshape the world we live in with technology. Just to highlight a few on the next slide, the way we look at this, from left to right, we look at 1,200 plus tech companies in the universe, and we look at the big themes driving tech. So this would be cloud computing, 5G, which we're all very excited about, Internet of Things, digital finance, artificial intelligence. These are the big ones. And I think if you talk to any technology manager, they'll say something similar. These are pretty universally agreed upon. But one thing that we do quite different is we look beyond just those big themes to focus on even smaller themes. And I'll actually circle back to one of the questions on chat, and please do keep them coming. I think it's great to see the interaction. This year we saw a lot of resilience in the tech sector. Now, how are we positioned for that? This is a very small chart, but if you looked at the emoticon 3 to the right of software, you see the phone to the computer to the tablet. This represents cloud-based communication. We owned companies in this area well before the coronavirus. You look to the right of that, the stop sign or the hand up with the three people, that represents cybersecurity. This is another sub-theme that we were exposed to before coronavirus and then accelerated during Q1 of this year. This is part of the areas of resilience in tech. So really, when you look at this slide, we invest in multiple different themes. Each one of these emoticons represents a sub-theme driving tech, and oftentimes we'll invest in a company or multiple companies to each one of these themes. And not to ramble on, but one other thing I would add is the way we get exposure to these themes. It doesn't necessarily need to be a large mega cap company. We see live streaming. So of course, Amazon and Netflix, but also companies like Roku, which is a smaller streaming player in the US. You see the sign of a POS, point of sale system, for digital payments. That can be Visa and MasterCard, but you could also own companies like PagSeguro in Latin America or Square in the US, smaller, faster growing names to get exposure to this theme. And the last thing I'd mention on this slide, sometimes we get questions, how much is too much? How many themes can you have? Well, I think it's important because to capture all of the technology disruption, you need to have that mindset of multiple different themes. And I think one of the best examples we've had year to date is this theme of telemedicine. You look on the slide about full right to services. being able to connect to a doctor through your mobile phone rather than go into a doctor's office, this was a huge trend over the past couple months this year. Who wants to go to a hospital during a health pandemic? If you can connect with your doctor through your mobile device, that'd be really great. So these are the type of themes we invest in, multiple different themes, and also themes where you may not get exposure to if you're only invested in mega cap tech. Well, maybe I'll hold it there, but that's a broad explanation of some of the sub themes.
I see there are a lot of great questions, and we're going to look at them later on. Before we go into those questions, let me ask you another thing. When we talk about themes, which is somehow similar to things that in a traditional portfolio management we look at. So when in traditional portfolio management in our investment process at HVB UniCredit, so we have. We look to a large extent on macro factors like GDP growth, monetary policy, inflation, and we do that with a focus on assessing where in the business cycle is the economy right now. And then we conclude that given that we see at which position in the business cycle we are, which sectors are most attractive, and then we allocate there. So my question is, how do you look at these macro factors? What is the way how you assess those? What is important for you? And also, how can that play along the thematic approach that you explained us?
Yeah, it's a good question, and we get this a lot, especially when markets are choppy, getting questions of how do you look at the macro as you would say in factors. And really, that's not how we approach the technology universe. We don't want to say one way is absolutely right and one way is absolutely not right. This is just our approach. So rather than looking at macro factors, we really focus on the themes, driving tech. This is most important for us. And also we seek out, a balance of where companies are in the cycle. We tend to focus on growthier companies who are aligned with one of these technology themes that we see as a structural tailwind for multiple different years. So for us, we focus less on macro factors and really focus on the themes driving tech. And if you don't mind, Philip, I see the questions coming in, and I promise we'll get to them. You got the question on U.S. election, which is a perfect example. How does that influence the way we look at the tech universe? And in short, it really hasn't changed very much of our outlook. The big factor from the regulatory standpoint is going to be focused on these big, large internet companies, right? And really, whoever wins the election, that will probably continue to be a focus. This is a quite smaller subset of companies, typically just the big mega caps, and it probably won't affect the longer term sub themes that we've identified. So really, we focus much more on technology themes and the company themselves, and really don't shift the portfolio very much in terms of macro factors or upcoming elections.
Okay, so there you have already a quite important kind of difference to the traditional way how we do portfolio management. Another question in this respect. In our investment approach in the DPM business, portfolio management business, we typically focus more on large, well-established companies. While in tech, there's a lot of talk about venture capital, so at a very, very early stage. Where do you position yourself in the life cycle of companies?
Sure. And I know, a lot of the call probably very focused on this venture capital standpoint, and we do see it as a big growth area. But for our funds, we see enough opportunity primarily in the public space. If you look at the next slide, this is really how we look at a company investment. This is a hypothetical example life cycle of a company. Early stage, private, whether VC or private equity. We have very little exposure to that, to be honest. Typically much smaller in our portfolios. What we tend to focus on more is we actually offer two different types of strategies for clients. One is what we call a world technology strategy, which is really our flagship strategy that is balanced between what's in the box on the screen. Roughly 50-50 between hyper growth and growth at a reasonable price. We think that offers clients a little bit of best world. You get some stability with the growth at a reasonable price, but also some of these really exciting hyper growth names where, not to insert my own bias, but I personally think is one of the most exciting areas of tech beyond just the mega caps and some of the faster growing, maybe more niche companies. And it's not just me. We actually had, a lot of client demand focus on that hyper growth standpoint. So we recently launched another fund 2 years ago called the Next Generation Technology Fund. This will focus almost exclusively on hyper growth type names. So for us, absolutely nothing wrong with VC and private equity investments, but we consider our investment universe more on the public side, greatly focused on hyper growth, but also some companies that have that growth at a reasonable price. And we want to avoid legacy. Legacy companies, once a tech company shifts their philosophy to fighting for relevancy or rather than growth, just focus on dividend payouts, that's where we would just ignore those type of names.
Okay, so another question more in respect to portfolio management. One task of portfolio management is offer investors exposure to a certain asset class or a sector or whatever. The other is maybe also offering different risk profiles within that area of investments. Do you offer different investment profiles also?
Yeah, exactly. I think that's exactly it. And that's really, I completely agree that comes from the client side as well. We have some clients who like the balanced approach. You want some of that FANG exposure. And also one of the questions that came in, how do you look at a benchmark for tech beyond FANGs? It's very difficult to do, but what we aim to do is really look beyond just the top 100 tech companies and focus on just the emerging growers. So basically different risk profiles. If you're more balanced, tech exposure, world technology has roughly equal exposure to hypergrowth and GARP. If you have a more aggressive risk tolerance, more comfortable investing in companies that have a wider range of risk and reward, a next generation technology can fit that description. So we do offer different profiles for different clients.
There has been a lot of talk about the funds, and you already mentioned the funds, and I can see that there are a lot of questions which we can discuss later also from the audience about. But you already said that it's important to be beyond fund stocks, right? So what is your view in respect to all this, and also in respect to maybe a regional allocation strategy, because FANG is closely associated with US investments? What's your perspective on this?
On a regional allocation? Yeah, one of the questions on China. These trends are truly global, and our portfolios are very global in nature. Now, the way it pans out, the majority of innovation and disruption in the tech sector is predominantly within the US. So when you look at our portfolio allocation, US is our biggest exposure. But China is very high, and it's not just China as well. I could touch on, US-China trade relations in a sec, but, it's really all of emerging markets. Our funds roughly have up to a quarter of the portfolio in emerging markets. About half of that is in China. So you're talking 12, 13% within China allocation. Maybe I'll answer my own question I posed a little bit, but how do we think about opportunities in China in relations with the US? Do we pick a side, or how do we balance that? And quite simply, rather than picking a side, it's more of we identify themes, and we can invest in companies that play this theme and domiciled in China and domiciled in the US. So really parallel exposure. Food delivery is a good example. We own a food delivery company in China. We also own one in Europe and one in the US. We do the same for digital education and telemedicine. We have some exposure to China and some to the US. So it's really a matter of parallel exposure to these themes.
Thank you. And there is another important thing when we talk about investing, also in respect to what happened during Corona crisis, where equity prices were swinging significantly. And also, not only the prices were swinging significantly, as a consequence, of course, also valuation was swinging considerably. And we've seen times where valuation has really spiked and reached areas where a lot of traditional investors get really concerned about these types of PE ratios. So an important question when investing, in particular in tech, I guess, is valuation. How do you approach this complex? How do you approach valuation?
Yeah, we get this question all the time, and we get it in two parts. So, one is now the right time to invest in the sector? And then secondly, how do you look at specific companies? And there's plenty of examples in technology where you see headlines, Tesla's trading at, some huge PE multiple, and Square is the same way at over 100 PE. Frankly, price-based valuation metrics just don't work for companies that are in hypergrowth. You look at this slide on the screen, hypergrowth. How do you use PE for a company that's growing revenue at 30-40% per year? It just doesn't really work that way. So the way we look at it is a much more all-encompassing view. One is we build discount cash flow models for companies in the portfolio. So that has a 7-year outlook rather than just 1 or 2. So one, you have to look well beyond just 1 or 2 years. And then secondly is taking a bit more of a fundamental view. How is this company positioned in the industry? Is there, management targeting the company in the right place? So there is a bit more of a fundamental qualitative analysis rather than just looking at these price-based metrics. And the one thing I would add to that, one thing that the team does a lot is they have over 1,000 company meetings per year. Having direct exposure to the companies themselves is quite critical. I think, especially when you're trying to learn how to, appropriately value and analyze a company that you're looking to invest in.
Okay, thank you. And now we come basically to the last question that we discussed before, and you were already picking it up a little bit. It's about the election. Next Tuesday there is election day in the US. So how do you see this topic? What is the risks? What are the potential implications coming out of the US election for technology?
Yeah, look, maybe it's good we have it in twice, because we've it's come up so often, and really, we see little or to no impact on the technology sector. Data privacy, antitrust concerns, these are bipartisan issues. They will certainly come up, but regardless, we don't see meaningful policy changes against the tech sector specifically. Potential rollback of the Trump era corporate tax cuts is certainly a possibility for a headwind, but that would be much more broad than just the technology sector. So really, it hasn't had very much influence on the way we look at our portfolio.
Okay, so we have another 9 minutes left. I think we should look at some of the questions in more details that were asked by the audience.
Yes, I'll invite actually those that ask questions. You're more than welcome to grab the mic. Then you can also enter the stage and ask your questions directly. I think that's probably the best way. So I invite you to do that. But in the meantime, maybe AJ could answer all the questions that we have in the comments. There's quite a few good ones there.
Yeah, I can keep them brief. One thing I don't think I answered very well. If we actually flip to the next slide, appropriate benchmark for a tech beyond FANG. We really just look beyond the top 100 tech companies by market cap. So in a very simplistic type of way, that's sometimes what we look for a next generation technology benchmark. One other quick one: how do we tell overhyped themes from more solid opportunities? That's a great question. we saw in March and April, especially with remote work type companies, valuations, I don't want to name any specific companies, but, got very high very quickly. And I think the answer to that, if the theme has substance, you need to look at the company level more specifically to see if there's continued room to grow. We measure it through revenue growth. There were companies that were in this remote working space that we sold or trimmed significantly as it became a bit overhyped. So for us, it's really, if it can continue to grow, we'll continue to invest in it. But if we think that it's really just overhyped and the growth isn't there, that's something we would avoid. I think I mentioned a bit investing developed market or emerging markets. We really invest in both. These themes are so global. Even, you could pick any theme out, digital payments, e-commerce, some of these big ones, these are really global. And oftentimes Asia is the leader in these themes. You think about digital payments, we're here in Europe. Europe's actually one of the laggards of adopting digital payments. Asia's way, way far ahead. So really we invest in both funds very into emerging market opportunities. Chinese tech is similar. We'll invest in China as well. About half of our emerging market exposure is there. So it's something that we're very keen on. And the other one I see, stock market in the future.
There's a question from Tobias. Speaking of being overhyped, do you see a tech bubble forming in the stock?
The tech bubble question. Yeah, to answer that, really no. If you compare now to tech bubble, it's a completely different story because these companies are delivering much stronger earnings and cash flow. It's just completely different than what we saw in the early 2000s. So in short, we do not see a tech bubble. There could be short-term market corrections, but nothing even close to a crash because look at these companies, how they're earning. They have the fastest revenue growth rates, strong free cash flow margins, and some of the healthiest balance sheets of any other sector. So we think there's enough stability there. And that doesn't even incorporate, the societal reliance on technology. Think how much your life has shifted towards technology today versus in the 2000s. It's just completely different. So in short, no, we really don't think there's a bubble forming.
AJ, there's an interesting question from Neil. You answered in respect to the US election about political implications. What about Europe, where we have already a lot of talk about regulation, tax policy in Europe? What's your view on that?
For tech regulation here in Europe?
Yes.
Yeah, really not much influence on the portfolio. It hasn't. Europe's one of our smaller exposures, to be honest, but it really hasn't been something that's influenced portfolio positioning. For us, it's more so looking at these themes and what's the best companies to exploit these type of themes, regardless of region. So in terms of regulation, it really hasn't influenced the way that we look at investing in some of these themes.
I think there's a quite interesting statement / comment / question from Anton, who's asking about the changes in the stock market given the democratization of finance and people that have lesser knowledge start trading.
Yeah. We get that sometimes, especially in some of those big stocks like Tesla is a pretty popular one. You see all these Robinhood accounts that are opening up and trading. We talked a lot about this with the investment team. We don't think there's significant influence on the market because the tech sector is just too big to be significantly influenced by the increasing number of smaller traders. I think it can have, results in a bit choppier markets at times, but broadly, this is a sector that, aggregate value of 20 trillion. It's just not really going to be influenced too much by some of these, newer, let's say, retail stock traders, if that makes sense.
And there's been a quite early question, probably when I was speaking about sector cyclicality and the COVID crisis, about whether there is an explanation between the relationship between this kind of cyclicality and resilience in COVID. Yeah. So to some extent, that is of course also outside the tech part, which is clearly driven to some extent by healthcare. But is there also anything that you could provide us from within the tech sector on this?
Yeah, I think there's a lot of areas within tech that, previously may have, I think previously people could view technology as just like a luxury, but now it's almost like a consumer staple in a lot of aspects. The most clear example would be in software. Software is very sticky. Stickier revenue, try continuing to run your business without Microsoft Office. That's a very simplistic example, but I think there's a lot of areas in tech that are much more resilient today than we would have thought of 10, or even 5 years ago. So I think especially in areas of software, some of the larger cap companies that are much more stable, these have actually turned into areas of more resilience, and we saw that in the first quarter of this year.
Thank you very much. I'd like to thank you both for coming over here and sharing your thoughts. We will continue this discussion on Wonder. I just posted a link in the chat, so you can actually talk directly to AJ and to Philip over there. So I'll encourage you to enter there, and yeah, thanks again.